Hello friends, last week in my video, I told you that risk appetite was rising, but necessarily prices may not follow suit. And I gave you reasons in a special segment, when will the markets rise? I told you that the four index heavyweights, Reliance, Infosys, ICICI Bank, HDFC Bank, were not really moving in tandem, and the Nifty was not really going past the 18,115 and 18,350 levels. Now this week was dominated by the Hindenburg report and the consequent decline in Indian markets. Where are we headed? I'm going to talk about it in this video. I would also request you to join my free Telegram channel. It's absolutely free, wherein I put in as a matter of fact, the maximum amount of our work and research is free and put up on our Telegram channel. I've also explained to you why there are other reasons for the market's decline, and please acquaint yourself with what I'm saying there. Let's dive right in, and on your screen right now, what you're seeing is the market roundup window, which tells you that the fall was led by banking. Not really surprising if you've been following my work on Telegram and in my videos. I'm going to come to that in a little bit. The US dollar index continued its fall, which cushioned the declines in emerging markets, including India. And the falling dollar boosted bullion or gold price at least. Silver fell a little on profit taking. Crude and natural gas fell, and natural gas has been a crowning glory. As far as my work and output on our Telegram channel is concerned, I've been telling you since August that prices were going to fall, and they've done very, very sharply. From $8 per MMBTU now to almost $2.50 per MMBTU. More research will be put up out there, of course. The USD INR, which is the dollar versus the Indian rupee, rose by 48 basis points, which means the rupee has fallen a little. And the 10-year benchmark bond yield has reached 7.40. That is the highest after 9th of November 2022. The NSE has lost a little under 4% in market capitalization, which was expected in a declining week. MWPL has fallen, which is routine after expiry, and it starts building up from here onwards. The US markets were up, and typically it was the Nasdaq, the technology-heavy Nasdaq, that led the rallies, which means the Indian IT stocks may also receive some amount of support. Coming to our in-house indicators, on your screen right now is the market-wide position limits. This is the total positions utilized as against the 100% allowed by the market regulator. Now what you're seeing is last week the peak was reached at 31.53, and then on Thursday there was expiry, and market-wide position limits normally obviously fall after expiry because not everybody rolls their positions over. Two things to note. The peak reached in the January futures series was 31.53, whereas the December series it was 33.40. So risk appetite at the peak was lower. Number two, the fall after the expiry of December took the MWPL to 22.92, but the fall after the expiry of January has taken it to 22.46. So even the low is lower. So both the high and the low are lower, which tells me that retail traders are hesitant. And this is something that will come in other statistical evidence to follow. Now for the stock and index futures turnover, this is cumulative 3 series, that is February, March and April. What you are seeing is stock futures turnover has gone up. This is only futures. Don't mix it up in the fag end where retail risk appetite footprints are concerned. And it's in the upper end of the 20-week range, whereas the index futures turnover has also risen on a week-on-week basis, but not as sharply as the stock futures turnover, which means that one Marshmallow traders have participated in the decline. Now for the NSE advanced decline ratio, what you are seeing is that the advanced decline ratio has remained below 1 for the third consecutive week. One Marshmallow traders were clearly in no mood to buy whatsoever. They were not supporting the market. The Marshmallow theory is explained in the pinned comment below, as also in the description below this video. Do acquaint yourself with this very important theory, please. Now for the basis. Basis is nothing but the premium enjoyed by futures over the spot. What you are seeing is the Bank Nifty basis has escalated to 316 rupees and the Nifty 50 basis is almost 83 rupees. Basis rising after expiry is routine because operators and traders are getting the entire month to play around with in their derivative positions. But historically, we have seen that the basis that we are seeing on the Bank Nifty has proved to be unsustainable. So 300 rupees plus is not something it will sustain. Why is the basis rising? I've also explained in my Telegram channel. In very brief, I'll tell you, it's because of short covering. Guys who had gone short on the Bank Nifty are very happily booking profits by buying back their short positions, and the bulls are making them pay a higher premium. As long as the basis remains positive, short covering cushions will limit the downside to a certain degree. So I don't want the basis to go into negative, which means the futures should not trade at a discount to cash. Keep an eye out for basis inversion. Now for the impetus. This is something that is an exclusive in-house indicator, not available anywhere on the internet. I shared it with you 7 quarters ago and it stood the test of time. Note how both the Nifty and the Bank Nifty impetus are up. As a matter of fact, the Bank Nifty's impetus is sharply higher, which is why I've shared a detailed Nifty versus Bank Nifty report on Telegram. Please check that out as well. Now, impetus is a momentum or a force indicator. It tells you how much force there is in any price move. Last week, both the indices fell and the impetus is up. That tells you that selling was very forceful. That is not exactly good news for the bulls. Now for the LWTD indicator, which I have shared with you 3 quarters ago. And this has also been a very accurate indicator. This is the 4th consecutive week where the LWTD line has remained below 0. And as I have been pointing out, both in my daily and weekly guidance, especially on the daily updates on Telegram, buying has been very muted as long as LWTD remains below 0. So bulls are not supporting the market on declines. Sure enough, bears are covering their shorts when markets are going up. That is limiting the downside, but that is very different from bulls resorting to fresh buying. Don't mix up the two. So in the coming week, because the LWTD has fallen sharply, I don't expect extremely strong buying to come in, barring some surprise positive announcements in the budget. Do remember, this is the budget. Coming week is the budget week, and anything happens on Wednesday onwards. It will all depend on what news and what announcements the Honorable Finance Minister makes in the budget. All the other in-house indicators done, I now come to the crux of this video. The bond market. Bond yields have gone to 7.40 after 9th November 2022. That means bond prices have fallen. How does it matter? Because the biggest holders of bonds are banks. And when bond prices have fallen, banks are witnessing a mark-to-market loss on their bond portfolio. It's a notional loss. They haven't booked it yet, but the stock market punishes banking stocks by pushing share prices lower. We have been at the forefront. We have been far ahead of everybody else. We're covering bonds in our weekly and daily updates on social media and YouTube channel, etc. are concerned. And unfortunately, what not many people are understanding is that the cost of funds is going up. Coupon rates or interest rates are going up. The cost of money is going up. Money is becoming more expensive. So two things happen. Number one, people pull money out of riskier assets like equity and park it in fixed income because the returns are higher. Number two, even to buy in leverage, and when a bull market comes, not everybody buys with their own money. People also buy with borrowed money. That borrowed money is becoming more expensive. And that is why the buying might ease a little. Thirdly, when interest rates go up, companies that have to depend heavily on EMI-based sales witness a slight fall or maybe even a bigger fall in their business volumes. And there is a risk of delinquencies, if not rising defaults in payment of EMIs. Do remember this aspect of the market, my friends. Cost of funds is something the wealthy understand. There's a difference between wealth and richness. Richness is having liquidity and money. Wealth is understanding that money. The wealthy understand the concept of cost of funds. I don't think too many people are taking that factor into account. Cost of funds is going to go up. Let's now come to the Bank Nifty, which bore the brunt of declines by falling 5.09% in spot. It fell on 3 out of 4 trading sessions, as you can see on the daily chart on your screen. The price has fallen below the 41,840 swing high, which it had made in September. And it was respecting all throughout December and so far in January. So falling below this support level is a notable event to have occurred last week. And the price is below its 25-day exponential moving average. I use the 25-day for the Bank Nifty and 20-day for the Nifty 50 because of higher volatility in the Bank Nifty. The average is a proxy for a month-long holding on cost of an average bull. Now that bull is underwater and the average itself is falling, which means that there is a mark-to-market loss of serious magnitude hitting the bulls in the Bank Nifty. A previous swing low, which happens at 37,386, needs to be watched as a support. I'm not saying it necessarily needs to go there. It may or may not. But do remember that on Wednesday and Friday, there have been power candles, huge, large candles that cannot be wished away. So at higher levels, there will be overhead supply coming from trapped bulls who will try to exit their longs and limit the upsides. Take a look at the weekly chart. Now, just look at the last 4 candles. The 4th candle from the last was a bearish candle. Then it was followed by 2 very small bodied candles that were contained within that bearish candle. Now this was consolidation happening there. And the final candle is the largest candle possibly in recent times. And unfortunately for the bulls, that is a bearish power candle. Not only has it fallen to a multi-month low in terms of price, but the 25-week exponential moving average, which is a proxy for a 6-month holding on cost, has also been breached. I told you about mean reversion in my previous videos. When the price either goes sideways and the moving average comes to catch up with the price, or the price falls downwards and touches the moving average and bounces. That's mean reversion. Now that the price has broken below the moving average, this is no more mean reversion. If the price bounces back above this moving average, fine, it was a whipsaw and the bulls might regain control. But if the price starts to stay below the moving average, then possibility of a downside or a down thrust beginning is elevated. Friends, in the week before last, the Bank Nifty was at number 8 on our statistical beta list of most volatile counters. Unfortunately for retail traders, it has moved up 4 notches to number 4. Why unfortunate? Because volatility or statistical beta jumps up exponentially as the rankings go higher, which means bigger challenges for traders. you tend to get thrown out of your positions with whipsaws more often. Last week, I advocated a range between 43,850 on the upside and 41,150 on the downside, which was admittedly breached. These were exceptional times, unpredictable times, and the low was 40,149. So my support was violated by 1,001 points. In the coming week, I expect a range between 41,800 on the upside and 38,850 on the downside. And to be perfectly honest, I'll be the first to admit that this range might be breached. Why? Because of A, there is a lot of panic in the market. B, it's a budget week, and maybe there could be some announcements which could cause either euphoria or panic in the market, and ranges might expand. So this week's range is a mere indicative range rather than me betting the bank on it. I would tell you to trade light with tight stop losses because of the volatility involved. Friends, let's now go to the Nifty 50, which fell 2.35% on a week-on-week basis. And like the Bank Nifty, it fell on 3 out of 4 trading sessions, as you can see on the daily chart. The chart of the Nifty looks relatively weaker in the absolute near term for the simple reason that the 20-day moving average, which is a month-long holding on cost of an average bull, has been sliding since December. It was pointing lower. And the price had remained below that 20-day moving average. Now, it's fallen sharply below that average. Will there be a reverse mean reversion, which means the price trying to catch up to the moving average by rising upwards? Yes. Short covering could occur. Like I told you, fresh buying is not forthcoming easily, but short covering has been cushioning the markets if you check the past LWTD updates on our Telegram channel. Here again, the previous swing low at 17,700 odd level, which was holding for at least 7 weeks or 6 weeks, has been violated on a closing basis. That's not exactly very great news for the bulls. The weekly chart shows you an exact identical pattern of the Bank Nifty. Just look at the last 4 candles. The fourth from the right has been a bearish one. The 2 following candles were contained within the body of that candle. Consolidation was taking place there. They were dragonfly dojis with the body in the center of the trading range and open and close being close to each other, which means indecision. And when a final decisive move came last week, it was to the detriment or the disadvantage of bulls, and a very large bearish power candle has been formed that has breached the 25-week exponential moving average, which is the 6-month holding on cost. So now mean reversion is over. Will it result in bearish markets? That depends on how long the price remains below the 25-week exponential moving average, and is the exponential moving average also turning downwards. Do monitor that in the coming week. In the week before last, the Nifty was number 14 on the volatility rankings on our in-house statistical beta list. It rose by 3 notches to number 17. Now, has the Nifty become less volatile? Not necessarily. The answer lies in the post, what is weaker, Nifty or Bank Nifty, which is there on our Telegram channel. Number 2, individual stocks saw a lot of volatility, and their volatility rose in relative terms much more faster than the Nifty 50, which is why Nifty appears to have fallen in volatility rankings. It's not an absolute fall. It's a relative fall. There's a difference out here. My statistically minded friends will understand that. Last week, I advocated a range between 18,500 on the upside and 17,550 on the downside, which was again breached because the low was 17,494, which was a decline of 56 points below my expected support area. In the coming week, I expect a range between 18,100 on the upside and 17,100 on the downside. Here again, I say the range might be breached in either direction. It's a very news-heavy week. The biggest trigger of them all, the budget, and anything can happen. So please trade absolutely lightly. Now, friends, I come to the footprint of the retail risk appetite. The methodology I have adopted is very simple. If the retail guys are trading stocks more than they are trading indices, the risk appetite is higher. If they are trading stock futures more than stock options, the risk appetite is the highest. But if trading in individual stock futures and options is lower and index stock futures and options is higher, risk appetite is lower because indices are less volatile than stocks. And in the index itself, if options are trading more than futures, the risk appetite is the lowest. Now, on your screen is the daily chart of 20-day look back, which tells you that index futures turnover rose on a week-on-week basis. Index options turnover is also higher on a week-on-week basis, whereas commensurate period shows stock futures and stock options turnover to have been lower as a total component of the entire market's turnover. That shows risk appetite is shrinking. The next chart on your screen shows that the decline after expiry in index options turnover is not as big as the decline in the prior week. That means the lowest risk instrument, index options, actually saw higher interest from retail guys. That tells you that risk appetite has absolutely contracted. Now, when risk appetite contracts, people are on the back foot. So volatility tends to go up because momentum can begin to get escalated in either direction. Friends, this would be a week to play your hand very carefully. Now I come to the segment wherein I tell you what I would do in the coming week. Color me chicken if you want, call me a deadpan guy if you want to, but Monday and Tuesday I would prefer to do nothing in equity markets unless our statistical beta in-house trading model, the IBEX, shows up very compelling trades. I don't mind waiting it out and hearing the budget on Wednesday and taking my bets thereafter. And even if I do take the bets, I would take them with a light footprint. I would again continue to bet on theta decay. I would continue to bet on the interest rate sensitives, companies that are dependent more and more on EMI sales. And as I've written in my Telegram editorial, a detailed thing on cost of funds and whether I would invest money or write out more checks in laddering sovereign investments. It's all there. I've already made myself clear there, so I'm not repeating it here again. Friends, I now come to the most popular segment of this video for the statistically minded trader, wherein I give you 5 stocks which have gained the most amount of beta or volatility on Friday. And there you take a small exposure, wait for large price moves on Monday. And 5 stocks where statistical beta has fallen the most, impetus has fallen the most. And you take big exposure, wait for small price moves. This would help scalpers. Do remember this list is valid only for Monday. If you want this list updated for you Tuesday through Friday, please join our free Telegram channel. It's completely free, no money to be paid anywhere, no subscription model at all. So on your screen right now is the list of stocks that have gained statistical beta or impetus, where you take small exposure, wait for large price moves. List is led by Ambuja Cements, followed by IRCTC, 3rd Ramco Cements, 4 India Cements, and 5th Bajaj Auto. Impetus losers, where you take big exposure, wait for small price moves. The list is led by Bharti Airtel, followed by Divi's Labs, Indigo, LTTS, and the last, Laurus Labs. Friends, I hope my video is helping you become better traders and understand the nuances of the market better. I would love to hear about your experience and feedback in the comment section, which I look forward to eagerly. Before I sign off from this video, a reminder to subscribe to my YouTube channel if you haven't already done so. and click on the bell icon to receive instant alerts about fresh videos being put up out here. Help me reach out to a wider audience of smart investors and traders like yourselves by sharing my video with your social media platforms and friends and family. Thank you for your patience in being with me in this video. Till we meet again in my next. This is Vijay Bhambwani signing off for now. Have a very, very profitable week ahead. Bye-bye.